Here's a paradox that quietly unsettles most retirees when they finally understand it. The single best retirement account in the entire American tax code is not your 401k. It is not your Roth IRA. It is not your traditional IRA. It is an account most people opened as a throwaway afterthought during an open enrollment meeting, the health savings account, and the benefits it unlocks. At 65, make every other retirement vehicle look ordinary by comparison. And yet, the vast majority of people who own HSAs are using them wrong, draining them for routine doctor visits in their 50s, never letting them compound, and walking into retirement having completely missed the most elegant tax move the Internal Revenue Code allows. If you have an HSA and you are approaching 65, or you are already past it and still holding the account, what I'm about to walk you through will almost certainly change how you think about the next 20 years of your money. Because at 65, your HSA does something no other account in America does. It becomes a fully flexible retirement account that is better than a traditional IRA, better than a Roth IRA, and better than any taxable brokerage you own. And it is entirely legal, entirely in the tax code, and entirely yours if you use it correctly. Before we go further, and this video is for educational purposes only and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. With that baseline established, let us unpack the only account in the tax code with a genuine triple tax advantage and why 65 changes the game completely. The health savings account was created in 2003 as a companion to high deductible health plans, and from the beginning, it offered something unusual. Contributions go in pre-tax, which means they reduce your taxable income in the year you contribute, just like a traditional IRA. The money grows tax-free inside the account, just like a Roth IRA. And then, when you withdraw funds for qualified medical expenses, those withdrawals are also tax-free. 3 layers of tax protection on the same dollars. No other account does this. A traditional IRA gives you a deduction going in, but every dollar coming out is taxable. A Roth IRA gives you tax-free growth and tax-free withdrawals, but no deduction going in. The HSA gives you all 3. For 2026, the contribution limits are $4,300 for self-only coverage and $8,550 for family coverage, with an additional $1,000 catch-up contribution allowed at age 55. That means a married couple in their late 50s, both over 55, and both with their own HSA-eligible coverage arrangement, can functionally stash over $10,000 a year into HSA accounts between them. If you max those contributions for even 10 years, and the account grows at a modest 6% average annual return, you're looking at somewhere in the neighborhood of $135,000, sitting in a fully tax-sheltered vehicle by the time you reach 65. Most people never come close to those numbers, because they treat the HSA like a checking account. They pay doctor visits out of it as expenses come in. They never invest the balance. They leave it in a 0% savings sub-account. And by retirement, they have a few $1,000s instead of a small fortune. The retirees who win with HSAs do the opposite. They pay current medical expenses out of their regular checking account. They save every medical receipt in a folder or a digital scan, and they let the HSA grow, invested in broad market funds the way a retirement account should be. Every receipt they save is a tax-free withdrawal they can claim at any point in the future, even decades later. James, a retired postal worker from Cedar Rapids, Iowa, figured this out at 52. He started maxing his family HSA, investing the balance in a low-cost index fund inside the HSA custodian, and paying all his medical bills out of pocket from his regular paycheck. He kept every receipt in a shoebox in his home office and later scanned them to a cloud folder labeled by year. By the time James turned 65, his HSA balance had grown to $182,000. His receipt folder contained over $40,000 of unreimbursed medical expenses accumulated over 13 years. That means James can withdraw $40,000 tomorrow, tax-free, with no strings attached, just by submitting receipts he already has. The remaining balance continues to grow, and he has total flexibility to use it for future medical costs, long-term care, Medicare premiums, or starting at 65, almost anything else. That last point is where the game genuinely changes. Before age 65, any withdrawal from an HSA for non-medical purposes triggers both ordinary income tax and a 20% penalty. That penalty is severe, significantly harsher than the 10% penalty on early IRA withdrawals. But at 65, the 20% penalty disappears entirely. Gone. Your HSA becomes a hybrid account. Qualified medical withdrawals remain completely tax-free. Non-medical withdrawals are simply taxed as ordinary income, exactly like a traditional IRA. No penalty, no surcharge, just regular income tax treatment. That means at 65, your HSA is, at minimum, equivalent to a traditional IRA for any purpose, and functionally better than a traditional IRA for any medical purpose, including the ones most retirees do not realize qualify. This is where retirees get genuinely excited when they finally see the list. Medicare Part B premiums are a qualified medical expense. Medicare Part D premiums are a qualified medical expense. Medicare Advantage premiums are a qualified medical expense. Medicare deductibles and copays qualify. Long-term care insurance premiums qualify, up to annual limits tied to your age. Dental work qualifies, including crowns, implants, and orthodontics. Vision care qualifies, including prescription glasses, contact lenses, and laser eye surgery. Hearing aids qualify. Prescription drugs qualify. Home modifications for medical reasons qualify, including grab bars, ramps, and stair lifts. Certain long-term care services qualify. Transportation costs to and from medical appointments qualify, tracked by mileage. The only major exception at 65 is Medigap supplemental insurance premiums, which, by specific statute, do not qualify as HSA reimbursable expenses. Worth knowing. Linda, a retired librarian from Grand Rapids, Michigan, uses her HSA as her Medicare payment account. Every month, Medicare deducts her Part B premium from her Social Security check. Every month, Linda reimburses herself from her HSA for the exact amount of the premium, fully tax-free. Over the course of a year, she pulls roughly $2,200 from her HSA without paying a penny of federal or state income tax on any of it. If she had pulled that same $2,200 from her traditional IRA in her tax bracket, she would have owed somewhere around $500 in federal tax alone. That $500 a year, compounded across a 20-year retirement, adds up to over $10,000 of preserved wealth on top of the compounding of the HSA balance itself. Now let us talk about the trap most retirees do not see coming. Once you enroll in Medicare, you can no longer contribute to an HSA. This is true even if you are still working, even if you have a high deductible health plan through your employer, even if you want to keep contributing. The moment Medicare coverage begins, HSA contributions must stop. And here is the subtle part most people miss. If you enroll in Medicare after age 65, Medicare Part A actually backdates your effective coverage up to 6 months prior to your application date. That means if you enroll at age 66, your Medicare coverage is treated as having begun at age 65 and 6 months. Any HSA contributions you made during those retroactive 6 months become excess contributions, subject to a 6% excise tax under Form 5329, unless they are withdrawn with their earnings before the tax filing deadline. This is one of the most common HSA mistakes retirees make when they continue working past 65. The fix is straightforward once you understand it. If you plan to delay Medicare because you are still working with a qualifying employer plan, you can continue HSA contributions as long as you do not enroll in any part of Medicare, including Part A. If you plan to enroll in Medicare at 65, stop HSA contributions 6 full months before your expected Medicare effective date to avoid the backdating issue. This coordination matters because the excise tax stacks year after year on excess contributions left in the account. Pull them out in time and you avoid the whole problem. There's another quiet advantage most retirees never use. Once you turn 65 and are enrolled in Medicare, you can also reimburse yourself from the HSA for your spouse's Medicare premiums, even if your spouse has their own separate HSA or no HSA at all. A married couple can effectively run both sets of Medicare premiums through a single HSA, tax-free, which is often the most efficient way to drain a large HSA balance without triggering any tax at all. If one spouse dies, the surviving spouse can inherit the HSA and continue to treat it as their own, with full tax-free medical reimbursement intact. This is one of the most underused wealth transfer tools in the tax code. Now the cautionary note on inheritance. If your HSA passes to a non-spouse beneficiary, the entire account becomes fully taxable to them in the year of your death. This is brutal. Unlike a traditional IRA, which at least gives non-spouse beneficiaries 10 years to stretch distributions under Secure 2.0, a non-spouse HSA beneficiary gets a single large taxable distribution with no deferral option. If your HSA has grown to $200,000 and you leave it to your adult daughter, she receives $200,000 of ordinary income in one tax year, likely pushing her into a significantly higher bracket. The protective strategy here is to either name your spouse as the primary beneficiary, or if no spouse, to consider draining the HSA tax-free for qualified medical expenses and long-term care during your lifetime, rather than leaving it to non-spouse heirs. You can also name a charity as the HSA beneficiary, which eliminates the tax entirely and redirects the balance to a cause you care about. Dorothy, a retired accountant from Scottsdale, Arizona, structured her estate plan around this rule. She built her HSA aggressively in her late 50s and early 60s, and by age 72, it had grown to $260,000. Her plan is to use the HSA as her dedicated long-term care fund. She has already priced out a hybrid long-term care insurance policy that allows premiums to be paid directly from her HSA, up to the IRS age-based annual limits. At 72, that limit is around $6,000 a year, fully tax-free. By the time she reaches her mid-80s, the annual limit rises considerably. Her goal is to fully deplete the HSA, either through long-term care expenses, Medicare premiums, or qualified medical expenses before she passes, so that nothing is left to become a taxable windfall for her heirs. If she does not use it all, her backup beneficiary is a local hospital foundation, which receives the remainder tax-free. Let us cover 3 specific traps before we close. First trap, many retirees forget they can use their HSA for expenses incurred years earlier, as long as the original expense was incurred after the HSA was opened and has never been previously reimbursed. There is no statute of limitations on reimbursing yourself from your own HSA. If you opened your HSA in 2010 and have 16 years of saved receipts totaling $50,000, you can withdraw that $50,000 tomorrow, tax-free in one lump sum, with no tax reporting issue as long as you keep the receipts for potential audit. This is one of the most powerful, most overlooked liquidity tools in retirement planning. Second trap. The HSA custodian you use during your working years may not be the best custodian for retirement. Many employer-linked HSAs charge monthly fees, offer limited investment options, and sit on a fixed menu of high-cost mutual funds. Once you are no longer contributing to the HSA through payroll, you can roll your HSA to any custodian you choose, usually with no tax consequences, and open up the full universe of low-cost index funds, treasury bills, and ETFs. Look for a custodian with no monthly fee, a low or zero balance minimum for investments, and access to major low-expense ratio funds. The one-time rollover rule allows one rollover per 12-month period, or you can do a trustee-to-trustee transfer, which has no limit. Moving from a high-fee HSA to a zero-fee investment-grade custodian typically saves retirees hundreds of dollars a year in fees, compounding over a 2-decade retirement into thousands. Third trap, do not confuse an HSA with an FSA, a flexible spending account. FSAs are employer-offered accounts that must be used within the plan year or forfeited. HSAs are individually owned, they never expire. They follow you between jobs, they follow you into retirement, and they are fundamentally your property. If you have been contributing to an FSA during your working years, those funds are not part of your retirement strategy. They are use it or lose it in real time. Your HSA is the long-term vehicle, and the two should never be confused. The math bridge on this one is worth seeing in full. Suppose you are 55, you contribute the family maximum plus catch-up every year through age 64, you invest the balance in a diversified index fund averaging 7%, and you pay all your current medical expenses out of pocket from regular income, keeping receipts. By age 65, your HSA balance will be in the range of $150,000. If you retire at 65 and use the HSA to reimburse all your Medicare Part B, Part D, dental, vision, hearing, and long-term care premiums, plus your out-of-pocket medical spending, you will likely draw somewhere between $7,000 and $10,000 a year tax-free from the account for the rest of your life. The tax savings alone is worth $1,500 to $2,500 a year in avoided taxes on equivalent IRA withdrawals. Over a 25-year retirement, that is between $37,000 and $62,000 of pure tax savings, on top of the tax-free growth you already captured inside the account. Pure, clean, completely legal tax alpha. Most retirees will never hear this breakdown from their employer. They will not hear it from most financial advisors because HSAs generate no commission and are rarely the centerpiece of an advisor's toolkit. They will hear it from a son or daughter who stumbled into it online, from a colleague who retired smart, or from a channel like this one. That is how this information travels, person to person, retiree to retiree, and that is how you protect your own money. If you have an HSA right now and you're not investing the balance, log in this week and check. Move the uninvested cash into a diversified index fund inside the HSA custodian's platform, or roll the account to a better custodian if yours does not offer strong investment options. If you have receipts from years past that you never reimbursed, start compiling them. If you are approaching 65, map out the exact month Medicare will begin and stop HSA contributions at least 6 months before that date. And if you are already retired with a sizable HSA, think about how to systematically spend it on qualified expenses during your lifetime, so the balance does not become a tax trap for your heirs. The simple discipline of treating your HSA as a retirement account rather than a checking account is the single mindset shift that separates retirees who extract full value from the HSA from those who leave most of it on the table. Pay current medical costs from regular cash flow when you can. Save receipts. Invest the balance for long-term growth. Coordinate Medicare enrollment carefully. Then, starting at 65, Deploy the balance strategically to cover Medicare premiums, long-term care, and qualified expenses tax-free. This framework, applied consistently over a decade or two, can produce one of the largest tax-free asset pools you will ever own, and it does so quietly without drawing attention from the IRS or requiring any exotic strategy. The HSA is the tax code's quiet gift to disciplined savers, and the retirees who recognize it for what it is tend to come out meaningfully ahead. I put together a short, one-page HSA retirement checklist covering the receipt, tracking system, the custodian comparison criteria, and the Medicare enrollment coordination timeline. If you want me to send it your way, let me know in the comments with the word HSA, and I will make sure it reaches you. While you are there, subscribe so you do not miss next week's breakdown on the exact difference between a Roth conversion ladder and a qualified charitable distribution, which is where most retirees with required minimum distributions are losing the most money to avoidable taxes. Until then, take care of your balance, save your receipts, and remember that small rules compound into large wealth. See you in the next one.